Sometimes things just don't go according to plan. Not often because of the contractor's inability, but I mean you just find unexpected things, which is why I like projects where there's not a ton of moving parts and not a ton of risks to manage.
If you're not conscious about your investment strategy, you won't end up where you want to be, not financially or as a human. On this show, we interview highly successful investors and share how they overcame limitations to become unstoppable forces of success. If you're ready to learn what it is to be a conscious investor so you can end up where you want, keep listening.
Conscious investor, welcome back. As always, I am joined by an amazing friend and fellow investor. And one of my favorite things is meeting people in person. And when you get to see people multiple times over years, it's really even better. But what's even better is that recently, you recall, I've been going to a lot of events. I was able to stay a little extra longer to go to a mastermind event, and it was a smaller group of people. And it was so much fun getting to know our guest today, David, in just like a more deep, rich way. It was so much fun. Everybody there was just connecting and talking about investing in such a rich way, made my brain sweat at times, which was fantastic. And I love that because that's where the growth happens. So remember, conscious investor, if you haven't yet found an event to go to this year, or even if it's within your community, a little local RIA or something like that, go surround yourself by people doing what you want to do and find people that are doing that at levels light years above where you are. Don't be intimidated by it. Step into that because that will help you level up in a very powerful way. This is why I'm so excited to have David Kamara on the show today. He is just an elite investor. He thinks in a whole new plane, and our conversations just make my brain go to a whole new level, including our conversations off screen about our kitty cats and the types of little things that they do outside the house. So without ado, I just want to say, David, so excited to have you on The Conscious Investor.
Thank you so much, Julie. It's a pleasure to be on your podcast.
It is awesome. And man, Conscious Investor, we have two topics. Usually I don't just come right out of the gates and tell you what this is, but we've got two topics for you: when deals are delayed and value add in today's market, right? Because these are two really hot topics. You have been investing as passive investors. And so you are kind of curious, like, why are these deals getting delayed and what is going on? And you want to know, is this value add multifamily really the best path for me at this time? I mean, interest rates and all the other things taking place. So David has closed out a couple of deals recently and has so much experience with both of these topics. I thought there couldn't be a better person to share and go in depth with us on. So David, where should we start? We want to talk about delays and deals?
Sure. Delays and deals are definitely an interesting topic and one that passive investors sometimes encounter and may want to know a little bit more about. We just closed the deal in June. Actually, it was exactly 3 weeks ago on this one. We closed two deals last month, so I'm kind of figuring out which deal am I talking about. 3 weeks ago, we closed the deal that we started working on back in February. And clearly that deal was delayed for very unanticipated reasons. And like they say, you always learn something new. So very, very interesting deal. Nice, simple, without any quote hair on it, 55 unit property in Jackson, Michigan, which is about 40 miles from where I live in Ann Arbor. This came to my attention through some people that I'd worked with before, guys that we bought property together with before. They actually found the deal and wanted to essentially partner because they couldn't do it on their own. And they liked our relationship prior, and they're like, hey, we love working with you. Let's go do it. So we're in due diligence. Everything is good. We've walked through the property. We've walked through all the units. We've looked at all the documents that the seller has provided. And there's one thing left to do, which is just to call the city assessor's office to understand what the tax situation would be. So I do that. I call them up and I'm like, hey, here's the address. Here's the number we're thinking. Can you give us some ballpark on, what taxes would be the following year? And I get this number, which essentially takes me aback. I'm like, wait, are we talking about the correct address here? They're like, yes. I said, is there anyone else I could speak to? Because that seems a bit higher than it needs to be. So they transferred me to the actual assessor. He wasn't there at the time, but they gave me his number. I called. We kind of played phone tag for a second, called me back, and I said, so could you shed some light on this? What's happening? And he says, well, all the apartment buildings in this town have been selling for significantly higher than what we had been appraising them at. And originally we thought that this was a one-off scenario, but then it just kept on happening. So essentially what we have done is we reassessed all buildings in this town. And so if you own any property, you usually get the tax assessor letter sometime around March. And it says, this is not a taxed bill, right? It says, this is just your assessor note. And mostly you don't pay attention to that much because in most states, the way that taxes are allowed to go up is capped, right? So in Michigan, it's 5% is your maximum increase that you can ever have as an owner, whether it's a single family house or commercial property. The thing that is important is there's something on there called the SEV, which is the state equalized value. And that value, even if it goes significantly higher than what it was the previous year, doesn't matter to you as an owner until you go to sell the asset, right? So when you go to sell the asset, essentially, if your state equalized value is dramatically higher than what it was before, what it does is it allows the municipality to tax that property at a much higher rate. So this is what they did with this specific asset. So actually, when I called and spoke to the assessor, those letters hadn't even been mailed yet. So the seller had no idea that this was even happening.
Oh my gosh.
So essentially, I called the seller up. I called the broker and said, listen, we have an issue. We probably need to talk to the seller because this is not even just an issue for us as a buyer. This will be an issue for any potential buyer of this asset. And it's frankly killing your value as an owner, as the seller. And I said, the rough math was the taxes went up from $60,000 a year to $180,000. And that just did not work in the model, right? There's no way that would have worked.
Wait, so can we just, conscious investor, did you just hear that? Triple? Like imagine if you were living in an average place and let's just say that your taxes are, $2,000 a year. Well, now you've just gone up to $6,000 a year, but we're talking like apartment complexes, 60 to 180,000. It's killing it. Oh my gosh.
Yeah. I mean, again, like I say, I have bought a bundle of property. I have never seen an increase that large. I mean, and usually
understatement on your bundle of property.
usually taxes go up some, but I mean, and they tend to go up higher if the owner has owned the asset for a long period of time, right? Because if you think about it, right, properties appreciate over time, but the state is essentially capped at how much they can increase the taxes over time. So maybe the state is capped at 3 to 5%, but the property, a lot of property appreciated in the past, whatever, many years. So there's a bit of a disconnect. So when you're buying something from an owner that's held it for a long time, you kind of brace yourself for a large increase. And I think we had estimated something in the order of going from $60,000 to maybe $85,000, which is still a big, mighty increase, right? But I mean, this thing just kind of really made the deal not work at all. So we spoke to the seller and said, we don't know what to say, but if that indeed is the number, we probably will have to cancel this deal. The seller, the broker representing the seller, was actually a very interesting personality because they had spent a good portion of their career actually litigating tax increases with municipalities. So this was a specialty of theirs. So they're like, yeah.
Wow, that's divine.
I know. What are the chances? So they're like, wait, so the immediate response was, we are going to fight this and the city is going to lose because, I mean, this just doesn't make any sense. Like there's nowhere where this has happened and it has stood, right? It just doesn't make sense. And the assessor, when I had spoken to him, actually gave me some of the comps they used. And even using the comps they used, like the conversation was, well, hold on. Each of these assets has sold in this city for roughly about 60 to 70,000 per unit, right? Based on this new tax assessment, you're essentially saying that the units are worth between $90,000 and $100,000 per unit. That doesn't make sense from a valuation perspective. And the assessor said, yes, I know, but that's not the method we're using, right? So clearly for tax purposes and for valuation, there's multiple ways to value a building. The assessor said that they were using the cost of new construction and giving it some kind of a depreciation factor because it's not brand new, right? The property is built in the 70s.
Oh, wow.
So all of that, long story short, the seller took it to, there's a tax tribunal typically, mostly in the late fall or mid spring, not fall. Sometimes if you miss it at the city level, you have to go to the state level, but they were able to go there. They actually requested that we actually cancel our contract to purchase until they were through this process, because they said they didn't want, the city saying, well, you have an offer at such and such a price. But even at that price, like, it was ridiculous. So we mutually canceled the contract. They went to the tribunal, presented their facts and comparisons, and they won. And the taxes still went up to about $97,000, but no longer $180,000. And they came back and said, okay, so here's where we are. Does this now make sense for you to go forward with? Yes or no? We looked at it. Clearly, 97 was more than our 85 in our model, but we felt still that the property was good enough and nice enough that we essentially agreed to purchase it at that price point. So that deal, needless to say, was delayed by about 2 months, where our investors were like, "Hey, so this thing was supposed to close early May. What's happening? Are we still doing this?" And eventually, we closed the second half of June.
This is amazing, and there are so many different elements here that are so critical, and even just like knowing that people are going to bat, knowing what's reasonable, knowing what you can combat, having a strategy as to know from that broker saying, we need you to cancel this, and then you guys also having the trust that they're going to still honor the contract. I'm going to cancel it. I'm going to trust that we're going to go through this process, and we're still going to come out together at the end. Like, there's a lot of trust right there that was built up. How did you already know this broker, or what was the rapport there that gave you the confidence of, or was it just simply, well, we'll just see what happens?
We had bought, I think, one other deal from this broker, but we'd seen a few other deals that they'd listed. And so, yes, we know them. We did have good trust with them. But yes, at some level, when you make that kind of a decision to say, we're going to cancel the contract, you do have to cover your bases, right? I mean, in our case, we had earnest money at the title company. It wasn't hard because, again, I'm not a big fan of putting earnest money hard until diligence is complete. And again, this is one of those reasons why that's a good idea. Right. Because had it gone hard earlier, I mean, essentially would have lost $100,000, right? Mm-hmm. Which, again, in this case, would have been a very poor way to lose the $100,000.
My gosh.
So you do have to, I guess, cover your bases. And one of the things that we are very big, we're very firm on is we never try to put earnest money hard without having walked through the asset and done the diligence. We have, at a previous deal, done a 15-day due diligence, just to let the seller know that we are not trying to waste their time, but we do want to, review documents and walk through the property, and we will do that promptly and quickly and not waste their time. And once we're fully happy, we let the money go hard. So in this case, once you're canceling a contract, you really have to make sure you cover all your bases, because there's really no guarantee it may come back. So from that perspective, we did that, in that our money would have been returned to us. In retrospect, I never called the title company to send us the money back. It just sat there even after the contract was canceled, in full anticipation that these guys may win what they set out to do. But yes, I mean, it worked out, and they honored the right to give us that first look once they figured out what their new taxes were going to be.
That's great. Okay, now you said you're investors, and this is where I know the conscious investor is going to be really curious, that your investors are like, hey, we were going to close. Were you already bringing investors into the deal at this point, or were they just kind of primed? Hey, we're going to release this deal. Where were they at in that mix?
Yeah, great question. So the way that we work is we start marketing a deal once we have it signed, meaning we have a purchase agreement executed with the seller, and essentially we're starting due diligence. So that's when we announce to our investors, like, hey, we have a deal. Here's why we like it. We're still in due diligence. Here are the things we're looking through. So yes, so our initial materials about the deal had gone out to folks, and people were looking at it, and people were expressing interest. Like, yes, I'm in for X amount. Let me know how it goes. Let me know when the legal documents are available. So we didn't start the legal documents until our diligence was done. Again, you're kind of trying to minimize your cost out of pocket. If you find something in diligence where, it may make the deal not go through, then you don't want to be spending money on legal. So when we found this out, we were still at the tail end of our due diligence. I mean, essentially, I let the folks who had expressed interest know that, we did hit a snag. This may go forward, or it may not, truly. And I mean, you haven't sent me any money, but know that this right now, there's a question mark on it because this tax situation. I kind of explained it, and I mean, people were patient and said that's fine. Let us know if this doesn't pan out. Let us know if you have something else. If it does pan out, let us know when the timing is. So I think we kept our investors abreast of essentially what was happening with it. I think there was probably a month of no news until we heard back from the brokers and the seller that indeed they did get a positive indication from the tribunal that they went to. And then very shortly thereafter, they got the actual valuation of what the taxes would be. So we kept investors abreast of what was happening, and I don't think we lost anyone on that one. So it was good.
I think transparency is so huge when it's like, hey, this is what's happening. There's usually a reason why. And so was it smooth sailing after that? Or you and I both know a lot of times the lending landscape right now is presenting some lags and delays. Did you guys hit any other delays in that process, or smooth sailing after this?
Exactly on point. We did have a bit of a delay with the lender. Just because of where interest rates were, and the Fed meetings were right in that May timeframe. They were raising rates. They were talking about stopping the rate hikes. So we were, again, still expecting to close sooner than we did. And for a period of time there, I mean, so this was an agency loan. It was a Freddie Mac loan. The purchase price of this deal is $3.3 million. We raised $1.2 million. And for a while there, we just had silence from Freddie. We're just waiting, like application submitted, all of the questions are answered. This is like our probably 8th or so loan with Freddie. And then they kept asking us some very interesting questions, like, we need a bank reference. And I was like, well, we have 6 loans with you. Or 7 loans with you. What other reference do you need? Like, I'm not sure I'm understanding the question. Right. And then there was like, okay, yeah, that's fine. And then there was, again, nothing for a few days. And then there was another question about some underwriting, which I'm not sure what was happening there, but it didn't seem to be like a question that should impede progress. And for a while, I wasn't sure they were trying to like delay the deal or raise the rates or what, but finally it went through, and we actually got a pretty great rate. I think we closed that one at 6.06% interest rate,
nice.
fixed for 7 years, with a step down prepay, which is what we wanted to ensure some flexibility in case we needed to refinance early.
Nice. That's interesting. I ask because the last couple of deals that we've closed have hit the delays on the lending, and it's interesting to watch, how the finance markets, as they've tightened and as they're shifting, and really they're repositioning themselves. And it's just one of those, I know that they need to protect themselves also, and they're trying. And so everybody's just making these adjustments, and it's causing these lags and these delays that are frustrating at times.
Yeah. Because I mean, at that point, usually if Freddie turnaround's about 2 weeks. I mean, in periods prior, and this one was closer to 3+ weeks, and so we weren't sure. I mean, are we moving forward? Are we not moving forward? Application's complete. Like, we're a repeat lender. We've had no issues in any of our assets. So it was kind of a period of uncertainty where you're just sitting there. And I literally sent an update to our investors, like, well, this is the period where we just sit around and twiddle our thumbs because we've submitted everything. Like, there's nothing we can do. We're just waiting. And as soon as they come back and tell us we can close, we'll close. Yeah. So we had that period. So yes, again, I think the important thing is just being open and transparent with investors and letting people know, what the actual facts on the ground are.
Mm, I love it. That's just a lot of rich information, and I appreciate it. I'm going to shift gears on us now. I was listening to a friend's podcast, and actually, I'll have to send this podcast to you because they're not in our ecosystem, but they're from my hometown, and they've been doing this since, 2008 or so. Really neat group. But they were talking about, they're in the value add space, and this is a great conversation, like value add in today's market. So we're seeing a lot of investors, wanting to go to alternative assets. We're seeing investors that have been around saying like, oh, I'm going to spin over into self-storage or light industrial, and I'm going to step away from multifamily because they're not certain of it for lots of reasons, right? And yet you're continuing the acquisitions, which, by the way, as are we. And I agree with them. Like, investing principles don't shift. You've always invest. Like, our guidelines don't change because something else has changed. It works or it doesn't work. Like, interest rates are high. Does the deal work? So let's talk about value add in today's market. Maybe some of the liabilities or responsibilities, or, your confidence in continuing to acquire value add in your markets.
Yeah, I think it's a great question. I think the market has shifted with, capital being more expensive, right? Interest rates are higher, significantly higher than where they were even a year ago. And it does present a different personality to the deal that you're typically going to see that makes sense. And we're seeing a lot more value add deals that have to be done versus the old kind of buy and hold and operate just slightly better, which I like those deals a lot more because there's frankly fewer moving parts. And you could say less risk, right? If you're just buying something and putting in better systems and being more efficient about sourcing things or how you turn the asset, that's different from buying something and you now will renovate a significant portion of that asset, which is more the kind of deals that, frankly, you have to do today to make returns worth the squeeze, so to speak. It's much more difficult to find the first type of deal, and it's much more common that the deals that people do today are more on the value add side. Now, I'd like to highlight one of the deals, the second deal that we closed last month, which is a value add deal as opposed to the first one, which was more kind of the slow and steady. The second deal came to us from my property manager, who's also my partner. And they happen to manage another property for another owner in that town. And so this is in the Grand Rapids market. Grand Rapids is in Western Michigan, a very well diversified market. It's got a lot of the cabinet makers and furniture makers nationwide are based there. Steelcase, a few others. And then it's got the university. There's a very big medical ecosystem out there. It's close to Lake Michigan, so it's a big tourism draw as well. So just a very nice all-around diversified economy. And rents are going up because a lot of people are moving there with, from all walks of life and all stripes and all professions. And construction just hasn't kept pace. So this property is in a suburb of Grand Rapids, and my property manager basically said, hey, we're managing this other asset in this town. And because there's so much demand for high quality apartments, the plan that we're currently implementing for this owner is rents are about $900, and we're essentially renovating these apartments and spending roughly $8,000 to $10,000 on the renovation. We're putting in vinyl plank floors, new kitchen cabinets, new counters, paint, just make it look nice, and new vanities in the bathrooms. And we essentially are able to raise rents $200 to $300, sometimes a bit higher, and we're getting that right with certainty. And so
It's been proven. It's not just we're thinking we can. Proof of
exactly.
concept.
Exactly. And so this other property showed up less than a mile from where they're already doing this. And the owner was more on the east side of the state, closer to Detroit. And so he didn't really have a pulse on the market. So we went, walked through this property, which was for sale, also walked through the other property, which my property manager currently manages. And we literally saw, the renovated units and what those rents are, the unrenovated units, what those rents are. And it just, that gives you so much more confidence that, this plan works. So that's the plan on that property. We bought that one literally a month ago yesterday. And we just celebrated a month. We have just started demolitions. We just filled out our first dumpster, and actually construction or renovations in full swing. It's a 40-unit property. We have 5 units that are available. We bought it with two vacant, and then 3 people moved out in this month, which was expected, which is totally fine because it gives us units to go renovate. And again, in Michigan, it's more preferable to have units available for lease in the summer months because it's warmer periods. People don't like to move when it's sludge and sleet and ice outside. So we're happy.
December, January, February are not moving months up north.
No, not at all. You kind of just sit with who you have for the most part. So that's a good example of a deal that we're working on that is definitely on the heavier side of the renovation, of value add side. And again, we're very opportunity focused, right? If an opportunity presents itself that makes sense and the numbers make sense, and we feel like we have a good handle on the risk, then we do it. Otherwise, we pass on a lot more things than we do.
It's really fascinating because I love that you had the proof of concept. I think right now that probably feels like a warm blanket for any investor. Like, oh, cool. Nope, there's proof of concept. We can do this. Would you have done that deal if your partner, who's also a property manager, had also said, hey, I'm confident that we could do this, even if there wasn't the proof of concept? Or where's your appetite with the real estate market? I love it. If you're listening, you just missed David's expression right there. You're like, yeah, let's talk about your investor appetite on, because you and I are both very conservative. I believe we're probably very similar in our groundings on like, no, we only do wise deals.
Yeah, no, it's very easy to lose your investors' trust, right? And so I am very cautious of that, and not to say I don't make mistakes, but I try to minimize the mistakes we make. And so, yes, the question you asked regarding appetite for value add, I would say I'm probably on the conservative side. So we don't do a ton of these types of deals, right? And the reason that this deal made sense is because we did have that proof of concept less than a mile away that I toured and saw multiple units and saw the rent rolls. And I trust my property manager, who is also investing their cash in the deal, right? So that's definitely a lot of data points that make me comfortable, as opposed to something else where maybe it's a property manager I don't know, maybe it's a market I've never invested in, and maybe it's working with contractors who I don't have a ton of confidence in their ability to complete on schedule and on budget. It does make a massive difference, right? Again, if you've worked with contractors, there's good contractors, there's not so good contractors, and sometimes things just don't go according to plan. Not often because of the contractor's inability, but you just find unexpected things, which is why I like projects where there's not a ton of moving parts and not a ton of risks to manage. We had a building that we lost to a fire right before the pandemic hit, and we had a year worth of what they call it is basically business continuity insurance. So essentially, the insurance company paid us a year's worth of rents for the building that we lost. It was a nine building property, and one building was 12 units. And essentially, we had a year worth of coverage from insurance, but it took us 2 years to rebuild because of COVID,
Wow.
because of slowdown, because of restrictions, because of shortage of labor, because of expense of materials. So I'm kind of burned by the experience that when you go to rebuild things, I mean, just a lot can go wrong. There was one instance where just the inspector didn't like the builder, and it was just like a bit of an ego match. Like, oh no, I'm going to fail you because I can, and I'm the one in power here, and you have to redo this thing. And it's like, can we just like play in the sandbox, please, guys? Like, what's happening?
Can we think about the residents here who need homes?
Yeah, no. So my point is, we try to not bite off too much, because at the end of the day, it's real people's money, and for our deals, we invest our money in each deal we do as well. So it's not that, oh, I made a bad decision and yeah, so investors didn't get paid. No, I'm not getting paid as well. And we very much align ourselves with our investors and try to make sure that whatever deals we do make sense and again minimize mistakes.
That's so prudent. I appreciate that. I just appreciate your perspective so much. It's, we went through a wave, and I think things are going to get flushed out, but we went through a period of time where there are, if you didn't have a background in real estate and didn't understand that real estate goes up and down and sideways and does cartwheels and jumping jacks and everything under the sun, if you didn't already know that, you just thought real estate was this great way to make a fast dollar. And it's like, now we're getting to the point where people are getting real of like, oh, real estate requires me to be paying attention and to really understand the mechanics and the risks and the liabilities, and to really have strategies to mitigate that. And I appreciate your grounded approach in your investing. And obviously, as a company that puts our investors, like investor-centric, it's like, does this make sense for our investors? It's always, that's the question every single time, is like, how is this serving the investor? How? Prove it. Like, we have to protect them. That's our responsibility, number one, because number two, then we can provide fantastic homes for residents, but we got to protect our investors first.
Absolutely. Absolutely. Well said.
Love it. David, I have thoroughly enjoyed, and I know that we could continue on this conversation because we both love real estate and we like talking about real estate together, but we have to wrap it up, which is really sad. Maybe we'll revisit this again in a year.
Sure.
What is the conscious investor I know is resonating because, the conscious investor invests with 3 keys investments because we are grounded, and you have that same grounding. And I always say, conscious investor, we don't do a lot of deals every year. We choose very wisely and we're very selective. And sometimes you have capital to deploy and we don't have a deal available for you in that moment. Maybe you're exiting one deal and you really need to redeploy, that capital. So it's really important to have a lineup of other investors that you've built relationships with that are aligned with your values and putting you first. And, so you want to make sure that you reach out, that you talk to David, have that phone call, so that you can be on that distribution list, because you don't know what's going to happen. And this supports you and your goals in a really powerful way. So David, best way for them to get in touch with you?
Thank you, Julie. Best way to reach us is our website, and it's Cape Sierra Capital, which is CAPESIERRA Capital, CAPITAL.com. It's a nod to Sierra Leone, which is where I'm from. So Cape Sierra is a big Cape, and there's actually my sister took a husband back there a few months ago, and they called and they're like, "Hey, I'm sitting at Cape Sierra right now." I was like, "Great!" Now all about. But while you're on our website, there's also a free ebook we have, which is called the Personal Cash Flow Formula, and that's at Cape Sierra Capital /cash flow. So check that out.
That is a great resource for sure. David, thanks again for coming on The Conscious Investor. And Conscious Investor, don't be a stranger. If you and I have not had a conversation yet about your investing goals, please make sure that you reach out. I'm not just a voice here on a podcast that is just here. I'm here to serve and support you in all of your goals. So don't hesitate to click on the link below in the show notes to schedule a time for us to connect. Until next time, live big, love bigger, and do great things. What's the big deal about investing in apartments? Why is it better than investing in a slew of single-family homes? I've compiled a lot of information on why investing in a multifamily, also known as apartments, will help you reach your investment goals. Head over to 3keysinvestments.com and download the Why Invest in Multifamily guide today.